On January 1st, 2026, a silent shift occurred inside the global silver market, unnoticed by the public, ignored by mainstream media, yet immediately recognized by banks, regulators, and industrial buyers who understood what disappearing metal truly means. There was no breaking news alert, no emergency announcement, and no official warning issued to investors. Yet behind closed doors, positions were flipped, vaults were locked, and access to physical silver quietly began to disappear. Two events happened on the same day, in different parts of the world, involving entirely different institutions, yet both pointed toward the same outcome: a structural shortage of physical silver that paper markets could no longer conceal. The first event involved the most controversial player in modern silver history, a bank long accused of suppressing prices, manipulating futures markets, and flooding exchanges with paper contracts to keep silver artificially cheap. The second event occurred in China, the world's dominant silver refiner, where new export licensing rules quietly came into effect, rules that would instantly remove a large portion of global refined silver from international markets. Individually, these developments might appear coincidental, bureaucratic, or technical, but when viewed together, they form a pattern that suggests planning, foresight, and an understanding of supply stress far ahead of the public. This story is not based on rumors, anonymous leaks, or speculative theories, but on regulatory filings, inventory reports, delivery data, and the actions of institutions that rarely move without absolute conviction. Because when banks, governments, and exchanges all act defensively at the same time, they are responding to the same underlying threat, even if that threat is never publicly acknowledged. To understand what is unfolding, we must first revisit the role J.P. Morgan played in silver markets for more than a decade, and why their sudden change in behavior matters so much. For years, J.P. Morgan was widely regarded as the largest and most aggressive short seller in silver, consistently betting against rising prices, while maintaining enormous influence over futures markets. Traders watched silver rallies abruptly fail as massive sell orders appeared without warning, often during low liquidity hours, creating the perception that silver could never sustain upward momentum. Regulators eventually confirmed manipulation, issuing fines approaching $1 billion for spoofing and fraudulent trading practices, penalties that barely dented the bank's balance sheet. Despite public punishment, the underlying market structure never changed, paper contracts continued to multiply, and silver prices remained disconnected from physical supply realities. But while traders focused on J.P. Morgan's visible paper positions, few noticed what was happening quietly in the background, far away from futures exchanges and trading screens. According to regulatory disclosures and vault reports, J.P. Morgan began reducing short exposure while simultaneously accumulating physical silver at a scale never seen before. This accumulation was not speculative, not temporary, and not designed for trading, but involved actual metal stored in secured vaults, removed from circulation, and unavailable to the open market. By late 2025, the numbers became impossible to ignore, revealing that J.P. Morgan controlled approximately 750 million ounces of physical silver. To put this into perspective, global silver mines produce roughly 800 to 850 million ounces per year, meaning one institution held nearly an entire year of global output. At prevailing prices, this position represented more than $40 billion locked into a single industrial metal, a move that makes no sense unless a fundamental repricing is expected. Banks do not allocate capital on this scale for short-term volatility or modest gains. They do it when they expect structural changes that permanently alter market dynamics. Yet the most alarming detail was not the size of the accumulation, but the timing, because J.P. Morgan completed this position precisely as global supply constraints intensified. On the very same day this accumulation reached maturity, China implemented new export licensing rules that fundamentally changed who could sell refined silver to the rest of the world. These rules required exporters to demonstrate large-scale production capacity and continuous export records spanning multiple years, conditions that instantly disqualified smaller refiners. As a result, thousands of previously active suppliers were removed from international markets overnight, despite still producing silver for domestic Chinese consumption. This effectively created a bottleneck in global supply, concentrating export power in the hands of a few state-aligned refiners and giving China unprecedented leverage over physical silver flows. China's export controls did not reduce silver production, but they radically changed access, ensuring domestic industries received priority, while international buyers suddenly faced uncertainty, delays, and shrinking availability across every major industrial supply chain. China refines between 60 and 70% of the world's silver, meaning control over refining effectively translates into control over the global flow of usable, industrial-grade metal. Most Western investors focus on mining output, but refining is where raw silver becomes functional for electronics, solar panels, medical equipment, and defense technologies. Without access to refined silver, raw supply is meaningless, and China's new licensing system turned refining capacity into a geopolitical choke point overnight. Export licenses became selective permissions rather than routine paperwork, allowing authorities to decide who receives silver, when shipments move, and under what commercial conditions. This strategy was not new, as China previously applied similar controls to rare earth elements, tungsten and antimony, consolidating pricing power through downstream dominance. By restricting exports quietly rather than banning them outright, China avoided market panic while still achieving maximum leverage over international buyers. Factories across Europe, North America, and India did not issue public complaints, but procurement teams immediately began searching for alternative sources. Those searches quickly revealed an uncomfortable truth. Alternative sources existed on paper, but physical availability was already constrained. As industrial buyers scrambled, another warning signal emerged from the futures markets, where demand for physical delivery suddenly surged. In December 2025, COMEX experienced an unprecedented wave of delivery requests, concentrated into just 4 trading days. Market participants stood for delivery on more than 47 million ounces, consuming nearly 60% of registered silver inventory. These were not retail traders or speculative funds, but entities willing to accept storage costs, logistics complexity, and long-term holding risks. In commodity markets, demanding delivery is the clearest signal that confidence in paper settlement is deteriorating. COMEX responded by sharply increasing margin requirements, making it far more expensive to hold positions that could result in physical delivery. Exchanges raise margins not when markets are calm, but when inventories are threatened and system stability becomes a concern. At the same time, registered silver stocks continued to decline, reaching levels not seen in decades. Registered inventory represents metal actually available for delivery, not total vault holdings, making its depletion especially alarming. While total silver still existed somewhere in the system, very little was freely accessible to satisfy delivery obligations. London's LBMA vaults, historically one of the deepest silver pools in the world, lost approximately 40% of their holdings over a short period. Shanghai inventories followed the same trend, collapsing to their lowest levels since 2016, despite rising industrial demand. When inventories decline simultaneously across independent exchanges, it suggests global scarcity rather than localized logistical problems. Instead of reassuring markets, institutions tightened rules, restricted access, and quietly prepared for further stress. These actions revealed a shared concern. Too many participants were asking for metal that might no longer be available. As physical silver vanished from vaults, a gap began forming between what paper contracts promised and what the physical market could actually deliver. As confidence in futures markets weakened, price signals began to diverge across global exchanges, revealing stress fractures that paper trading mechanisms could no longer smooth over through arbitrage. By late 2025, silver traded in Shanghai at nearly $8 per ounce above COMEX futures, a premium that persisted far longer than normal market dislocations. In functioning commodity markets, such gaps disappear quickly as traders buy cheaper metal and sell it where prices are higher. But arbitrage only works when metal can move freely across borders and between vaults without regulatory or logistical barriers. China's export controls and declining exchange inventories effectively broke that arbitrage mechanism, allowing regional prices to decouple. This condition is known as backwardation, where immediate physical supply commands a higher price than future delivery promises. Backwardation signals urgency, not speculation, because buyers are willing to pay premiums to secure metal now rather than later. Industrial users cannot pause production while waiting for futures contracts to settle months into the future. Solar panel manufacturers, electronics producers, and medical device companies require uninterrupted silver supply to meet contractual obligations. If silver prices rise, these buyers pay the higher price, because shutting down production costs far more than absorbing input inflation. This creates price inelastic demand, where consumption continues regardless of rising prices in the short term. As premiums widened, physical silver increasingly bypassed futures markets entirely, trading directly between refiners and end users. Paper prices continued to fluctuate, but they no longer reflected the true cost of securing deliverable metal. This disconnect eroded trust in futures contracts as reliable tools for price discovery. Instead of hedging price risk, contracts increasingly represented settlement risk, raising concerns among institutional participants. As confidence declined, more holders chose to stand for delivery, further straining already depleted inventories. Each delivery request removed metal from circulation, tightening supply and reinforcing the cycle of scarcity. Meanwhile, mine supply showed little ability to respond, constrained by long development timelines and byproduct dependency. Approximately 70% of global silver production comes as a byproduct of copper, lead, and zinc mining. This means silver output cannot increase meaningfully without simultaneous expansion in base metal production. Rising silver prices alone do not incentivize faster supply growth, unlike metals mined as primary commodities. At the same time, demand from renewable energy continued accelerating at double-digit annual rates. In 2025, solar panel manufacturing alone consumed over 200 million ounces of silver. This demand is structural, policy-driven, and unlikely to reverse even during economic slowdowns. With supply rigid and demand expanding, the silver market entered a phase where mathematics, not sentiment, began to dictate outcomes. Annual deficits in silver are not isolated events, because each year of underproduction compounds the shortage by draining existing inventories that cannot be easily rebuilt once consumed or locked away. Over 6 consecutive years, global silver demand exceeded supply, quietly removing more than 1 billion ounces from above-ground stockpiles worldwide. These stockpiles once acted as buffers, absorbing demand surges and stabilizing prices, but they were never designed to sustain permanent structural deficits. As inventories shrink, the system becomes fragile, where even small disruptions can trigger outsized price movements and supply chain stress. This fragility explains why exchanges responded defensively, tightening rules and raising barriers to physical delivery rather than encouraging open market participation. Such actions are not signs of confidence, but of risk management, as institutions attempt to slow depletion without publicly acknowledging scarcity. While exchanges focused on preserving stability, one institution appeared fully prepared for the transition from abundance illusion to physical reality. J.P. Morgan's massive silver holdings positioned the bank as both a beneficiary and a stabilizer during periods of market stress. With hundreds of millions of ounces in reserve, the bank could supply industrial demand selectively or withhold metal as prices adjusted upward. This control transformed silver from a speculative asset into a strategic reserve, similar to how oil stockpiles influence energy markets. The bank's earlier suppression of prices now appears less contradictory and more strategic, allowing accumulation at artificially low valuations. By the time physical scarcity became visible, the largest position had already been secured. For latecomers, available metal was limited, increasingly expensive, and subject to regulatory and logistical constraints. As awareness slowly spread, attention shifted from price charts to inventory reports and delivery statistics. These data points revealed a simple truth: there was not enough freely accessible silver to meet global industrial needs at current prices. This realization altered behavior across markets, encouraging hoarding, longer-term contracts, and direct negotiations outside exchanges. Once participants begin prioritizing access over price, traditional valuation models lose relevance. Instead of asking how cheap silver might become, buyers began asking how much silver they could realistically secure. This shift in mindset marked the transition from a financial market to a resource allocation problem. In such environments, prices do not rise gradually, but adjust rapidly as scarcity is acknowledged. Historical precedents show that commodities facing true shortages often experience sudden repricing phases. These phases persist until new supply materializes or demand is destroyed through economic contraction. In silver's case, new supply requires years, not months, to develop. Until then, the market must ration limited metal through higher prices and restricted access. With supply constrained and inventories depleted, the silver market entered the early stages of a structural repricing cycle. As prices began adjusting, analysts turned to historical benchmarks to estimate how far silver could move once physical scarcity replaced paper abundance as the dominant market force. One of the most closely watched indicators is the gold-to-silver ratio, which historically averaged between 33 and 35 ounces of silver per ounce of gold. In early 2026, that ratio remained elevated near 75-1, signaling silver was still historically undervalued relative to gold. Even a partial return toward historical norms would imply significantly higher silver prices, without requiring gold to rise further. At current gold prices, a ratio of 40 would place silver near $70 per ounce, well above levels most investors consider plausible. A full normalization toward historical averages would push silver closer to $80 per ounce, before accounting for any scarcity premium. But history also shows that during periods of extreme stress, ratios overshoot, driven by panic, hoarding, and industrial urgency. In 1980, during the Hunt brothers squeeze, silver reached inflation-adjusted levels exceeding $100 per ounce. That episode was speculative, but the current situation is fundamentally different, driven by genuine industrial shortages rather than financial leverage. When shortages are real, prices remain elevated until new supply enters the market or demand is forcibly reduced. Mining industry data shows new silver mines take 7 to 10 years from discovery to production. Even expanding existing operations requires years of capital investment, permitting, and infrastructure development. Recycling offers limited relief, as much of silver demand now comes from applications where metal remains locked in use for decades. Solar panels, electronics, and medical devices are not easily recycled without destroying functional assets. This reality constrains supply responses, ensuring that shortages persist longer than many market participants expect. As pressure builds, attention turns to exchanges and their ability to honor physical delivery commitments. If too many contract holders stand for delivery simultaneously, exchanges may face situations they cannot easily resolve. In such cases, force majeure clauses become more than legal language, signaling systemic failure in paper markets. A delivery failure would instantly shatter confidence in futures pricing as a legitimate reflection of supply and demand. Industrial buyers would rush to secure physical metal at any available price, accelerating repricing. Investors holding paper contracts would be forced to reassess exposure, potentially triggering rapid liquidation or conversion to physical holdings. At that point, price targets become irrelevant, replaced by a single question: how much silver is actually available? Markets would shift from speculation to rationing, where access determines value more than historical benchmarks. January 1st, 2026 may ultimately be remembered as the moment this transition became unavoidable. The silver market is no longer about prediction or belief, but about mathematics, physical reality, and who positioned early enough to survive the repricing.